Meet two versions of Zeo. Same age, same job, same income, same $50,000 in savings. Today, they make one different decision. Property Zeo uses his $50,000 as a down payment on a rental home. Index Zeo puts the same $50,000 into a diversified stock market index fund. Same starting money, two completely different strategies. Now we follow them for 20 years. We'll count appreciation, mortgage paydown, rent, repairs, vacancies, compounding, volatility, time, stress, and one cost most calculators leave blank: human behavior. Because 20 years from now, one path will look far more impressive. The surprise is that impressive and profitable are not always the same thing. Property Zeo finds a rental home worth $250,000. He puts down $50,000 and finances the other $200,000. Immediately, he gains something Index Zeo does not have: leverage. His $50,000 now controls a $250,000 asset. If the property rises 10% in value, that is a $25,000 increase on an investment where Zeo personally supplied only $50,000. Then a tenant moves in and pays $1,800 a month. The mortgage costs roughly $1,300. Property Zeo sees the $500 difference and smiles. Apparently, he has discovered money. Small problem: rent minus mortgage is not profit. It is the first line of a much longer subtraction problem. But Property Zeo barely notices. He has walls, windows, a roof, a tenant, a key. He can drive past the house and think, "I own that." Index Zeo has a very different experience. He puts $50,000 into a broad index fund and automatically adds $200 every month. Then, almost nothing happens. No tenant, no renovation, no key, just an app. Some days the number rises, some days it falls. Most days it is extremely boring. And that matters. We tend to value things we can see, touch, and control. A house feels real. A portfolio of tiny ownership stakes in thousands of companies feels abstract. So Property Zeo feels productive. Index Zeo feels like he has successfully automated a bank transfer. But the spreadsheet has not voted yet. 3 years pass. Property Zeo has collected more than $60,000 in rent. Excellent. Until the bills arrive. Property taxes, insurance, maintenance, advertising between tenants, vacancy, a broken appliance, and one plumbing problem that somehow selects the least convenient weekend of the year. That original $500 monthly profit gets smaller. Because rental property is not simply an investment. It is a physical operating business. Things break, people move, taxes rise, insurance changes. Then there is Zeo's time. Hire a property manager, and part of the rent disappears. Manage it himself, and evenings disappear instead. Either way, somebody pays. This is the first hidden cost. Property Zeo invests money and attention. Index Zeo invests money and patience. And patience has its own price. At some point, the market falls. Maybe 10%, maybe 20%. Index Zeo opens his account and watches thousands of dollars vanish from the screen. Nothing physical broke, but emotionally, it feels immediate. This is the strange difference between property and stocks. Property problems usually arrive one at a time. A repair, a vacancy, a difficult tenant. Stock market pain can arrive as one giant red number. Property Zeo gets operational stress. Index Zeo gets volatility stress. One comes through phone calls, the other through charts. Both can ruin breakfast. Now move forward to year 7. Something quiet begins happening to Index Zeo. His monthly contribution is still $200, but his portfolio is larger. The money invested years ago has earned returns. Those returns have earned returns. And gradually, the portfolio begins producing more growth on its own. This is compounding. At first, compounding feels almost pointless. You invest, you wait. You invest, you wait. Then years later, the money starts doing noticeably more work than you do. Property Zeo's growth arrives differently. The tenant helps pay down the mortgage. The property may appreciate. Rent may rise. His equity grows from several directions. That is why real estate can be powerful. But leverage has two personalities. When prices rise, leverage looks brilliant. When prices fall, The bank remains remarkably committed to receiving the mortgage payment. Leverage magnifies opportunity. It also magnifies exposure. Now we reach year 10. Property Zio's house may be worth far more than he paid. The mortgage balance has fallen. He has substantial equity. Index Zio's portfolio has also grown through market returns and 10 years of contributions. And depending on the assumptions, something uncomfortable happens to anyone hoping for an easy answer. The totals can be surprisingly close. This is where investment debates become very creative. Use higher property appreciation and real estate wins. Use higher stock returns and stocks win. Lower maintenance and property looks better. Raise it and the index fund suddenly looks brilliant. Congratulations. We have discovered the spreadsheet version of arguing. So ask a better question. Not which investment earned more. Ask what did each investment require from Zio to earn it. Property required debt, management, maintenance, concentration, and time. Index investing required patience, emotional control, and the ability to do almost nothing when doing something felt urgent. That last requirement is harder than it sounds. When markets fall, humans feel pressure to act. Sell, switch funds, move to cash, wait for clarity. Watch 15 experts explain 15 different futures. Doing nothing can feel irresponsible. That is action bias. Property creates almost the opposite experience. There is always something Zio can do. Repair, renovate, negotiate, refinance, find a better tenant. Activity creates a sense of control, and humans love control. Even when more activity does not necessarily create more return. Effort and outcome are not the same thing. An investment that demands more work does not automatically deserve to make more money. And an investment that demands almost no work is not somehow cheating. Money has never been especially impressed by how busy you looked. Now jump to year 20. Property Zio has benefited from leverage, appreciation, mortgage paydown, and rental income. He may have several $100,000 of equity. Index Zio has spent 20 years doing something much less cinematic. $200 every month, again and again. His original $50,000 has had 2 decades to compound. Under reasonable long-term assumptions, his portfolio may also be worth several $100,000. Property Zio may finish ahead. Index Zio may finish ahead. Or the results may be much closer than the online argument suggests, but their wealth is different. Property Zio owns a tangible, leveraged asset. It can generate rent. He has more direct control. But the wealth is concentrated. One house, one neighborhood, one local market. And if he suddenly needs $20,000, selling 12% of the kitchen may concern the next buyer. Index Zio's wealth is more liquid. He can sell part of the portfolio relatively easily. He is diversified across many businesses. But that creates a behavioral danger. He can also sell during a panic. Property prices can fall without sending Zio a flashing red update every morning. Stocks are thoughtful enough to show him the damage continuously. So who won? That is still the wrong question. Imagine someone who hates debt. A highly leveraged property may create years of anxiety. Imagine someone who cannot tolerate a 30% market decline. A stock-heavy strategy may lead them to sell at exactly the wrong moment. Imagine someone who hates tenants, contractors, and repairs. Landlording may become a second job they never wanted. But someone who genuinely enjoys finding properties, improving them, and managing operations may thrive in real estate. This is why investing is partly a psychology problem. Returns matter, temperament matters too. Because you do not receive the return shown in the ideal spreadsheet. You receive the return of the strategy you can actually stick with. So before comparing real estate and stocks, count 4 things. Money, what genuinely comes out after every cost. Time, how much of your life does the investment require? Risk, debt, volatility, concentration, liquidity, what can actually go wrong? And behavior, what does the strategy require you to do when things become uncomfortable? That 4th question is where many theoretical returns disappear. Property Zio may need to keep paying through vacancies and repairs. Index Zio may need to keep investing while the market falls and every headline explains why civilization has approximately 48 hours remaining. Neither path is effortless. The difficulty simply appears in different places. So real estate versus stocks? There is no universal winner. Real estate offers leverage, tangible ownership, potential rental income, and more direct control. Stocks can offer diversification, liquidity, low maintenance, and powerful long-term compounding. The better question is not which one looks more successful. It is which set of trade-offs can you realistically live with for 20 years? Because wealth is rarely built by finding one perfect investment. It is built by choosing a sensible strategy, understanding what it demands, and staying with it long enough for the mathematics to matter. Sometimes the investment that feels like you are doing the most is not doing the most for you. And sometimes the investment that looks like absolutely nothing is happening has been working the entire time. Money does not care which strategy looks impressive. People do. And unfortunately, people are the ones making the decisions.